Welcome to the deep dive. Today, we're tackling something that, well, might sound a bit dry accounting, but trust me, understanding this is key to seeing what's really going on with a company's finances.
Absolutely. It's fundamental stuff.
Specifically, we're getting into accounting changes, focusing today on a change in accounting principle and how companies handle it using the retrospective method.
That's right. A really important one.
Now, before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, the explanations we'll discuss, they're all derived from the comprehensive accounting resources over at farhatlectures.com.
Great resource.
So whether you're an accounting student prepping for the CPA exam or you're already a professional, definitely visit the website. You'll find extra practice questions, video lectures, and, detailed support for today's topic. Big thanks to Professor Farhat for providing this material.
Yes, definitely.
All right, let's get into it. Why do companies even make accounting changes? I mean, why not just stick with one method? And why is it so critical for us to understand these shifts?
Well, the core reason, really, is comparability. Think about it. If a company kept switching how it reports things year after year.
It'd be chaos trying to compare results.
Exactly. Apples and oranges, like you said. You couldn't track performance properly. Historical data just loses its meaning for trend analysis without a consistent approach to changes. You lose sight of the real business trajectory.
Okay, that makes sense.
And when we talk changes, there are basically three main types. There's the change in accounting principle. That's our focus. Then you have a change in accounting estimate and a change in reporting entity.
Right.
And it's important to stress, simple errors aren't accounting changes. Mistakes happen, but they're treated differently.
Okay.
Also, it's not a change if you're using a principle for the very first time, like for a brand new type of transaction, or if something was previously immaterial, just too small to matter, and now it is.
Good distinctions.
All three change types matter, but that change in principle often needs this retrospective adjustment we mentioned. That's what makes it kind of the most involved and why we're zoning in on it. Estimates, for example, are usually prospective, just affecting now and the future.
So let's focus on that change in accounting principle. What does that actually mean in practice?
It means the company is switching from one GAAP method, one generally accepted accounting principle, to another GAAP method. Both ways are okay under the rules, but they choose to move.
So not from something wrong to something right, but from one right way to another right way.
Precisely. Think about inventory. A company might switch from, say, the average cost method to LIFO last in, first out. Or, like the example we'll dig into, changing how they recognize revenue on long-term projects, maybe from the completed contract method to percentage of completion.
And that affects when the income hits the books, right?
Exactly, which can really change the profit picture year to year.
Okay. You mentioned different approaches currently, prospectively, retrospectively, and this retrospective method is the one for changes in principle. It sounds, well, challenging.
It often is the most challenging, yeah. It involves more recalculation, but it's crucial because it gives you that comparability we keep talking about.
Yeah.
It lets you compare apples to apples across different years.
Okay, here's where I really want to understand the mechanics. What does retrospectively actually do to the financial statements we see?
Right. So the core idea is you have to go back. You adjust the financial statements for every single period presented as if the new method had been used all along.
Wow, okay. Like rewriting history, almost.
In a way, yes. But it's to make the present and the past consistent, so comparisons are valid.
How does that play out? Are there different scenarios?
Yeah, let's walk through a couple. Say a company shows financials for 4 years, X1, X2, X3, and X4. They make a change in X4 that affects all those prior years they're showing. In that case, they literally have to go back and restate the numbers for X1, X2, and X3 using the new method. Everything presented gets updated.
Makes sense. Full consistency.
Now, what if they only present the current year, X4, but the change impacts X1, X2, and X3 years they aren't showing this time around? Yeah.
Okay, so you can't restate what's not there.
Exactly. So you still calculate the impact for those unpresented years, X1, X2, X3. You figure out the total difference the change would have made.
And then what?
Then that cumulative effect, the total impact from all those prior unshown years, gets adjusted against the beginning retained earnings of the first year you are presenting. So the start of X4 in this case.
Why retained earnings?
Because the income statements for X1, X2, and X3 are already closed out. Their net income has already flowed into retained earnings over time. So to fix the past impact, you adjust the starting balance of that cumulative profit pot.
You're essentially adjusting the starting point for the current year to reflect the past changes.
That's it, exactly. And one more scenario, quickly. If a change affects, say, X3 and X4, and the company is presenting both X3 and X4.
Then you just redo both.
Simple as that. You
Quick.
just recast X3 and X4 using the new method. No need for that big cumulative adjustment to retained earnings because all affected periods are right there being restated.
Okay, that clears things up quite a bit. It's definitely a lot of work to ensure things line up. Let's make this concrete. Bring in the Atom Company example. They switched from completed contract to percentage of completion in 20x4.
Right, so Atom Company, change happens in 20x4. Key points. Both methods are GAAP. Perfectly acceptable, they just switched.
Uh-huh.
And importantly, for tax purposes, they're sticking with the old method, completed contract. The tax rate is 20%. This difference between book and tax is important.
Okay, got it. So let's tackle the scenario where Atom Company only presents 20x4 financials. How do we handle the impact from the prior years, 20x2 and 20x3, which aren't being shown? This is where that cumulative adjustment comes in.
Exactly. We need to calculate the impact for those unpresented years. So for 20x2, under the old method, income before tax was $410,000.
Yeah.
Under the new method, it would have been $700,000.
Okay, so that's a difference, an increase of $290,000 for X2.
Correct. Now for 20x3, old method income was $170,000. New method income would have been $200,000.
So that's an increase of $30,000 for X3.
Right, so add those two together. The total gross income increase across X2 and X3 is $320,000. That's the $290K plus the $30K.
Okay, $320,000 gross increase, but there's tax.
Always taxed. The tax rate is 20%. So 20% of that $320,000 increase is $64,000.
Yeah.
That's the extra tax related to that extra income. $58K from X2's impact, $6K from X3's.
Got it.
So the final net impact after tax is the $320,000 gross increase minus the $64,000 tax increase. That gives us a cumulative net income increase of $256,000.
$256,000 net increase from the prior years. Now, how does that actually get put onto the books at the start of 20x4 if we're only showing x4? What's the journal entry look like?
Good question. At the very beginning of 20x4, they'd make this entry. Debit construction in process for $320,000. That's an asset account, increasing it to reflect the higher value based on recognizing revenue earlier.
Okay, debit asset.
Then credit deferred tax liability for $64,000. This liability reflects the taxes they now owe on that extra income recognized for book purposes, even if they haven't paid it yet because they use a different method for tax.
Credit liability. Makes sense.
And the balancing figure, credit retained earnings for $256,000. That's the net after-tax cumulative effect from X2 and X3. It flows directly into the starting retained earnings balance for X4.
Because X2 and X3 income statements are closed.
Right.
It all ties together. Now, beyond the numbers, transparency is huge here, isn't it? What do companies need to tell us?
Oh, absolute crucial. Disclosure is key. They need to clearly explain the nature of the change, what changed, why they changed, the new method. They also have to describe how they adjusted prior periods retrospectively, especially if those periods aren't being presented. You need to know how they got to that cumulative adjustment.
What else?
They need to show the impact on income, both income from continuing operations and net income for every year shown. And of course, disclose that cumulative effect on retained earnings or other equity accounts if relevant. Plus, any change in assets at the start of the earliest year presented. It's all about giving the user the full picture.
No hidden adjustments.
Ideally, yes.
Yeah.
Full transparency.
So if I was looking at Atom Company's statement of retained earnings for 20x4, how would I actually see that $256,000 adjustment?
You'll be shown very clearly. You'd see the beginning retained earnings balance as previously reported, let's say at $355,000 hypothetically. Then there would be a line explicitly labeled something like adjustment for change in accounting principle net of tax, showing the $256,000 being added.
Ah, okay.
That would lead to an adjusted beginning retained earnings balance of $611,000, $355K plus $256K. So it's right there, explaining how the starting point for the year was restated due to the change.
That makes it really clear for analysis. This has been incredibly helpful, really breaking down what can seem like a very complex topic. Understanding these principal changes and the retrospective method is just so vital for true comparability.
It really is. It ensures you're not misled by changes in accounting policy and can see the underlying performance more clearly.
So a final thought for you listening. Next time you see an accounting principle change disclosed,
Ask yourself, why did they change? What does this tell you about their strategy or their view of the business? And how does knowing about this retrospective adjustment change your reading of their past performance and maybe even their future prospects? What new questions does it raise?
Great questions to consider. And remember, if you want to solidify this, do check out Professor Farhat's resources at farhatlectures.com. Really valuable stuff for digging deeper.
Definitely worth a look.
Thanks, everyone, for joining us on this deep dive.